Well, hello there, deal makers. My name is Michael Blanc here, and we're going to talk about passive investing in real estate. And one of the questions we always get really is, well, why should I invest in real estate versus the stock market? And that's what we're going to talk about today. And to help us unpack that is our Director of Investor Relations, David Milan. David, welcome to the show today.
All right. Thanks, Michael. Thanks for having me on. Doing great. Glad to be here. So one of the things I wanted to lead with is, one thing that I've been having a lot of calls about recently, a common question I get is, investors are looking to potentially move their money from the stock market to real estate in light of these volatile times. And so I figured the next best thing to do is just to get an answer from someone who has tons of experience in the industry like yourself. What would you say? What are your thoughts on this? Why should investors choose to invest in real estate versus the stock market?
Well, I think the main argument, David, is that one shouldn't take all their money out and stick into something else. I mean, it just doesn't make a lot of sense. However, I can tell you, once you start investing in a multifamily syndication, you see how it works, you're going to start taking all of your money out of the stock market. But one step after another. First of all, the main arguments really is that the returns are actually higher than the stock market, right? We're typically looking at average annual returns of 12 to 15%. The stock market over the last 25% has been 7.1%. And number one. Number two is the multifamily syndication of real estate performs much better in recessions. We saw that in 2008. We're seeing it now in COVID, versus sometimes the stock market can lose 30 to 50%, which we saw in both recessions. And that can be very unsettling as you're trying to make financial plans for you and your family. Well, I don't know when the next recession is going to come, and then I'm down 30 or 50%. If I'm about to retire or I need that money for college, and now it's worth 30, 50%, that's a real big problem. So you have a consistency with real estate syndications. And number three, the tax law is written so that the gains on that are highly advantaged. You have huge tax advantages on the gain that you don't have in stocks. And so your taxes are a lot lower. And more importantly, there's cash flow in real estate syndications, which you don't get in the stock market unless you're doing very advanced call and put option strategies. So you actually have cash flow, which you can use to actually quit your job, right? I'm wearing this freedom shirt right now is because we want to control our time, and we can do that either by investing actively or by investing passively. Either one generates cash flow. So those are really the 4 or 5 main advantages of investing passively in syndications.
Right, and so you mentioned cash flow here. That's kind of the idea I want to center around right now. Could you expand upon that a little bit more? How is that possible? How frequent is the cash flow that they're going to get? And generally, what kind of cash flow can investors expect?
Yeah, a cash flow is a real key component of this kind of an investment, right? Because you can literally cover your living expenses with it. And so the question is, those are great questions. Really, what we're looking for is we're looking for average cash returns of 6 to say 8%, 6 to 8%. Meaning that if I invest $100,000 per year, I want to receive distributions in the amount of $6,000 to $8,000, and that's real money that you can use to do stuff with. But because of the tax advantages, when you get a K1, after you put $6,000 or $7,000 into the bank, your K1 shows a massive $40,000 loss because of the depreciation that tax laws allows you to do that. So it's fantastic. You put money in your pocket, yet you're not paying taxes on it. It's awesome. So that's about what you can expect. Now, typically, we do value add deals, meaning that we're going to get into a situation where a property cash flows are ready, but it's not where it needs to be. So it might take a year or two to get to that. So the first year might be, say, 3% cash on cash. It might go to 5%. But by year 3, we want to be right in that target, right? So 7%. And then it might get a little bit higher in year 4 and year 5 until we eventually sell. So typically, your distributions are made quarterly. Typically, they're made about 6 months after we close on a deal because we want to see how the property performs. We want to make sure that we retain a certain amount of cash for unforeseen circumstances, and sometimes those happen. So typically, the first distribution happens 6 months after we close, and then quarterly. Once things really stabilize, we'll go to monthly distributions as well.
Okay, great info there. Michael, on the topic of better returns, we know that the average stock market return over the last 15 years is 7%. And really, if you factor in taxes, fees, et cetera, we're looking at about 2.5% of real return. How do real estate syndications manage to achieve returns of 13% or more?
Well, okay, that's a great question. First of all, just the vehicle itself has higher returns. Just the way that syndications are, because it is an alternative. It's the one downside that we didn't talk about of syndications is that it's not as liquid. So you can't just call us up and go, hey, I've been in this deal for 2 years. I want my money out. while we will work to get that out, it's not as easy as calling a stockbroker. So the returns are higher, right? The returns are higher naturally than the stock market, right? And one reason that the stock market is lower is because of the volatility. So the average return has been 7 years, right? Sometimes it goes up and then it goes up and then it goes back down, reducing the principal. And so the compounding is not there, right? Because the principal is being reduced by years where there's losses. So the compounding is not the same, is not consistent year and year. And multifamily, if it goes up a 13% average annual return, it is compounded 13% average annual return. So that's a main reason for it. The fees are already built in. In other words, the returns are post fees. So there are fees involved that are paid to the operator at closing, during closing, and sometimes when you sell it. But the returns that we project are always after fees, right? And then there's taxes. You get a capital gain on stock, you had a great year, you're going to pay 20% whatever capital gains on that, and the tax code is written differently for real estate. So because of all these different reasons, that's why the returns are typically higher in a syndication.
Okay, so I want to latch on to that last idea really quick. You briefly mentioned the tax advantages of real estate. Could you elaborate on these advantages? Why are stocks subject to certain taxes while certain real estate properties are not?
Well, anytime the tax code gives you advantages, there's a reason for it, because the government wants you to invest in those things. That's why there are tax advantages, for example, investing in oil, specifically drilling of oil, right? Because the government wants you to invest in exploratory activities such as that. The government also wants you to invest in rental housing. Why? Because there's a shortage of affordable rental housing. So what can the government do to induce investors to invest in this asset class? And one of the things they do is tax advantages. It's the same thing with these opportunity zones, right? These are tax programs that provide incentives for investors to do something, in which case clean up entire city blocks. So it's the same thing here. That's why they're in place. The way it works is this thing called the depreciation. It's been in a tax code for decades, but it really allows you basically to write off the value of a piece of real estate over 27 and a half years. Now, if you do a cost segregation analysis, which is basically where you hire an engineer and they break a building down into its constituent parts. You got nails, you got electrical, you got roofing, carpet, furniture, whatever. And the tax code is written differently for how things can be depreciated. For example, wiring might last 10 years, right? Flooring might last 5 years. And so they apply this analysis on a building. And so effectively 90% of the value of the building can now be depreciated over 7 years, not 27 and a half years. So we bake that into each one of our deals. So as a result, 90% of the building becomes a phantom expense. So like I said earlier, we'll send you $8,000 as a return on your $100,000 investment. Meanwhile, you might have a $40,000 loss because of depreciation. And so that's really the magic of real estate and how that is advantaged over, say, something like stocks.
Okay, so with that said, with all that's going on right now, we're seeing unprecedented volatility in the stock market, whether that's due to COVID, changes in the political landscape, or just concerns about being in a bubble. What makes real estate such a stable alternative compared to the craziness of the stock market?
And this is one of the things I really love about multifamily real estate. There are other real estate classes, and not all real estate is created the same. So look at the last recession, for example. Real estate was hammered, but not every real estate was hammered. Right. So what was hammered was houses. We had a lot of foreclosures in houses, short sales, house values in Florida and California collapsed by half. Right. Office space got hammered, retail space got hammered, but multifamily space did not get hammered. Neither did mobile home parks and self-storage, for example. They actually thrived in the recession. And the reason for that really is because there is a continued shortage of affordable housing. You can't build affordable housing because construction prices are too high. Right? If you see an apartment building going up, it's always going to be higher end rent. It's the only way that the builder can justify getting a return on their money. Therefore, a housing around $500, $600, $700 per month, you cannot build that housing. Therefore, it's always going to be in demand. Now, do people lose their jobs in recession? Absolutely, but they need a place to live. So what they do is they simply downgrade to something a little bit more affordable. Okay, before they go completely homeless. But the default rate in the last recession, for 4% of government-backed loans defaulted in houses, only 0.4% of multifamily loans default. That's almost zero. And the only reason it's 0.4 is because it includes California and Florida, the hardest hit parts of the country at the time. Now let's look at COVID, right? COVID decimated the office and retail market space. I mean, I wouldn't want to be a holder of any of those right now, right? They're all vacant and unbelievable. Now, collections on multifamily side have been very constant, surprisingly constant, and you can speculate why that is, government subsidies, whatever. The point is our collections are equal to or possibly greater than they were before COVID. And so repeatedly throughout history, multifamily has performed very solidly in recessions. So it's not just has higher returns, but the downside is much, much more minimized because of how it performs in recessions.
All right. Wonderful explanations there. I'll leave you guys with this. If you guys are interested in investing in real estate, please view our free report at themichaelblanc.com/report. If you want to learn more about multifamily syndications and the benefits of real estate investing, please visit nighthawkequity.com, click the join button, and book a one-on-one call with me if you haven't already. My name is David Milan with Nighthawk Equity, and thanks for joining our show today.